We want to break down today's action, and we've got Lee Munson from Portfolio Wealth Advisors. He will tell us why he thinks investors should embrace a possible correction. Matt Jehn from Royal Oak Financial Group says investors should not sell in May and go away this year. And Joe Cusick is in the pits of the CME. Joe, let's start with you. You agree don't walk away right now. Why not?
Yeah, well, basically, if you look at it historically, let's say over the last 15 years, basically 9 out of those 15 years, it's been positive from the May to July. I want to put a little wrinkle in there. May to July, you've seen some positive returns there, about 1.3%. So I don't think anybody should be looking to sell until you get into that middle of the summer.
You know, Matt, we were having this discussion in the last hour about the fact that you're seeing, Matt, you're seeing that, you know, there's no growth in this country. We've got the GDP numbers coming out this part of the year are dismal. If the market up, and up, we're up again today. It's easy money. At what point does reality of the economy hit with what some say is not reality on Wall Street?
Well, I'm not sure that's going to happen. I mean, you know, we are starting to grow. We had a slow first quarter with the weather, and but once we get that behind us, I think because we're trying to grow, once things get some traction, we're going to do well. So we are market positive, and we're not, you know, sell in May, go away. You better be ready to come back in July, like your other guest said. We do think that's when some of the tripwires have been hit. But right now, we're positive on the market. When you look at all the variables, both abroad and here, and the pressures on the market, we continue to stay true to the 18,000 mark. That tells me we're getting ready to jump a little bit further.
Okay, well, Lee, you and say embrace the, I don't want to say corrections, but say the pullbacks like what we saw last week. You guys did that, but you're not putting all your powder here in the United States.
No, not at all. You know, last Thursday was a great example of how resilient this market is. It tried to sell off, but at the end, the bulls won. You have to have at least 30 to 40% of your equity allocation outside the United States. Number one, because almost half of the equities are outside the United States in terms of market cap. About 75% of the actual stocks are international. Plus, that's where you get cheap valuations, great dividends, and when you see Europe left for dead, that's a time to buy.
Well, Lee, but let me pick up on that, because what we're seeing here in this country and what we have been seeing for the last few years, easy money, the Fed's been printing, the markets are loving it, there's money everywhere. But now that's the Europe story. So what's to say that a lot of these American investors are going to wake up tomorrow and go, you know what, Europe looks better. I'm going to go there where the easy money is. Forget the U.S. I'm going to pull back at least on my U.S. holdings. What about that scenario?
Well, I think that's a scenario that we're already seeing since the beginning of the year. I remember the first week in January when George Soros said he was going to overweight international, the crowd went wild. So I think you're going to see that gradual movement over. Also, remember why U.S. investors are going over there. They're going over there for those great, rich dividends in big multinationals in Europe that are just dirt cheap right now. If you want to stay in the U.S., go for those smaller companies that have been overlooked, especially true small cap value. You get some dividends, and that's not where your average investor is going to flip out and go to Europe.
Okay, so let me bring Matt back into this, because you like the growth sectors that you're betting on are healthcare and technology. In fact, you like Micron Technology and Skyworks Solutions, both chip makers. Shouldn't we be afraid of chip makers right now as the world all goes mobile?
Absolutely not, because we are seeing the growth in the handheld devices, and we'll continue to develop this market, both Samsung and Apple as being the leader. We have been market positive on healthcare early on, and we still are, but now we have found in the technology sector, if you look at Micron Technology, they have a PEG ratio of a 0.6, a PE ratio forward of below 9, so they're way undervalued. And they have a beta of 1.7, so once they take off, they perhaps will outperform the market as a whole. And then if you look at Skyworks Technologies, they're more fairly valued with a PEG ratio of about 0.93, 0.94, and a beta of 0.5, so they're less risky as a market as a whole. Well, so the two of these complement each other very nicely.
And the technicals are fine to discuss, but I think we should be clear on what these guys do. And both of these companies are in the chip business. This is all about handhelds, mobile phones, iPads, if you will. This is your bigger overall bet that we're all walking around with our smartphones. Put your money into companies that have chips in said smartphones, right?
Absolutely, yeah. Micron's doing the flash technology, the rewrite technology on the disk, so they're making it quicker and faster. Skyworks is doing the semiconductors, the battery life. So the two of those are a great complement in the technology sector, and we think they're going to continue to do very well. And you'll hear that tonight with Liz Klayman at 8 o'clock when she's going to interview the big boys, and I think you're going to hear the same message come across when she comes on. I'm looking forward to it.
I think our promos are working at Fox Business this, Adam.
Yeah, they definitely.
The plan worked.
But something else that's working is putting our money to work. Lee, I got to ask you this. You just told us put 30 to 40% of your money outside the United States. How is this pick of yours, Target, following that scenario? Or what's at play when you think that Target is something you want to own, as well as Philip Morris?
You know, my clients are basically retired. They live off their income. So when I'm looking for an individual stock, I'm looking for something that could keep us in the United States in those large caps. So when we're talking about people moving away into Europe outside of large U.S., I'm looking for a great name that's here in the U.S. Target got smashed when they tried to go into Canada. They didn't understand the market. They had the big Visa card hacking scandal. Right now, it's got a great dividend. It's better than a 10-year Treasury. It's a name that we all know. They're doing a bang-up business right now. That, along with things like Philip Morris International, I think that's what's going to keep money here. I think you're less likely to have value players take their money out and go chase abroad. Well, that's why I like that.
And your point about Target, the stock's up 27% over the last year, and a lot of people were discounting that name, to be fair. Hey, Joe, you know, he's got a couple of consumer names here. He's talking about Target. He's talking about Philip Morris, excuse me. What do you say about the consumer right now? Like, we get all this spending data. They're confident they're spending, and then we find out, oh, they're not so confident. They're not spending. The data doesn't tell us the consumer is doing well, Joe. What do you say?
Well, I say this. If the consumer goes away, then that prophecy may come into fruition. I don't think the consumer is going away. The data is a little bit mixed, but the consumer names have been moving up for a reason, and that is that we still have strength in this economy right now as far as what we can buy and what we're able to buy. And I think right now the consumer names are the ones that you're going to see a lot of interest in, because what everybody's saying, yield, the dividends are coming up. The companies are starting to pay out to keep you interested. I think that's going to be the play, and it needs to continue to be the catalyst to continue this upside move well past 2,100 for the S&Ps.
Matt, if the companies have to pay to keep us interested, though, I mean, aren't we range-bound? Where is the breakout? When do we go better than Dow 18,000? You were talking about that just a few minutes ago.
Well, I think the consumer is going to come online here this summer. They have been very slow to acknowledge some of the benefactors that have been out there with recovering employment, lower gasoline prices. And again, you know, we did have the bad weather the first quarter, so we really got to wait till this summer to see what happens. But the consumer can push us forward, and as far as them having to give back the money to keep us interested, we want companies that are continue to raise the dividend and continue to pay that dividend. So you want to look for the companies that have a super long history of always paying the dividend and always increasing it. So that's a good thing. You want to see a company that's going to continue to give that cash back. That gives you the encouragement and the faith that you're putting your money in the right place.
All right. Lee Munson, Matt Jehn, and Joe Cusick, thank you very much for joining us.